Something just happened that has not happened in 30 years, and almost nobody's talking about it. Central banks around the world now hold more gold than US Treasuries in their reserves, more gold than American government debt, for the first time since 1996. I'm going to let that sit with you for a second because I do not think people understand how massive this is. For 3 decades, the world's central banks have said, we trust the United States government more than we trust gold. That is over. The crossover just happened. Gold is now 30.4% of global reserves. US Treasuries are 29.7%. The gap is small right now, 0.7 percentage points. But the direction is what matters. Gold is going up, Treasuries are going down. And the reasons behind that shift are going to shape the next decade of your financial life, whether you own gold or not. I am going to break down exactly why this is happening, what the data behind it means, and then I am going to show you something at the end of this video about what happened the last time the world went through an energy crisis like this one, because the parallel to 1973 is so precise it will give you chills. Stay until the end. Let me start with the Bloomberg chart because I want you to see this with your own eyes. Pull this up on screen. This is Bloomberg data sourced from the IMF and the World Gold Council. The chart shows gold holdings versus US Treasury holdings as a percentage of foreign central bank reserves from 1970 to 2026. 2 lines, gold in yellow, Treasuries in blue. For decades, the blue line was above the yellow line. The world held more treasuries than gold. That was the normal. That was the system. That was the foundation of the dollar's dominance. Buy American debt, earn yield, trust the system. In 2026, those 2 lines crossed. Gold went above treasuries. The crossover. The regime shift. The moment where the world's central banks collectively said, we would rather hold metal that pays no yield than paper that does. Think about what that means. They are choosing 0 yield over 3 or 4% yield. They are choosing something that sits in a vault and does nothing over something that pays them interest every month. That is not a financial decision. That is a trust decision. They do not trust the paper anymore. And when the institutions that literally print money stop trusting another country's paper, that is the most important signal the financial system can send. I've been watching this chart for years, waiting for this crossover, and honestly, I thought it was still a few years away. The fact that it happened now, in the middle of a war, in the middle of a dollar surge, tells me the shift is happening faster than anyone expected. Central banks do not move this fast unless they see something coming that the rest of us have not fully processed yet. That scares me a little if I am being honest, because central banks are the most conservative institutions on earth. When they start rushing into gold, it means the risk they see in the system is bigger than the risk of holding a 0 yield asset. That should make everyone pay attention. Now let me show you who is doing the buying because this is not random. China has been buying gold every single month, 15 consecutive months and counting. Russia has been converting oil revenue into gold for years. India has accelerated its purchases. Poland has been one of the most aggressive buyers in Europe. Singapore has been quietly building reserves. And the common thread between all of these countries is not geography. It is not trade policy. It is BRICS, Brazil, Russia, India, China, South Africa, and the growing list of nations that have joined or applied to join. These countries represent over 40% of the world's population, and they are all moving in the same direction, away from the dollar, into gold. This is not about earning a return on reserves. This is about de-dollarization. New payment systems outside of SWIFT, energy trade being settled in local currencies instead of dollars, reserve systems being backed by real commodities instead of paper promises from a government that adds $1 trillion to its debt every 100 days. And this is not theoretical. It is happening right now. Saudi Arabia has started accepting yuan for oil sales to China. Russia and India are settling energy trades in rupees and rubles. Brazil and China have established direct currency swap lines that bypass the dollar entirely. The BRICS nations announced a new cross-border payment system at their last summit designed to reduce dependence on the dollar-based SWIFT network. Every one of these moves chips away at the foundation of dollar demand. And every chip makes the next chip easier because once one country proves you can trade without the dollar, every other country starts asking why they are still using it. Let me say that again. $1 trillion of new debt every 100 days. And annual interest payments on that debt are now pushing past $1 trillion per year. The United States is paying $1 trillion a year just in interest on money it already borrowed. And the rest of the world is watching and doing math. And the math says this does not end well for the paper. That is why central banks are buying gold, not because gold went up, because the alternative is breaking. And here's the part that makes this personal for every American watching this video. When foreign central banks sell US Treasuries and buy gold instead, that means there are fewer buyers for American government debt. Fewer buyers means the government has to offer higher interest rates to attract new buyers. Higher interest rates mean higher mortgage rates, higher car loan rates, higher credit card rates, higher borrowing costs for every business in America. The shift from treasuries to gold is not just a chart on Bloomberg. It is a force that flows directly into your monthly payments. Every central bank that sells a treasury bond and buys an ounce of gold is making your cost of living slightly higher. And that process is accelerating. This is also why the dollar has been so strong recently, despite all the chaos. The demand for dollars to settle trades and buy oil is keeping it elevated. But the structural shift underneath is moving away from the dollar. The short-term strength is masking a long-term erosion. And the crossover in central bank reserves is the clearest signal we have ever gotten that the erosion has reached a tipping point. Welcome to the hidden economy. If you are new here, hit subscribe and hit the hype button. I cover the data behind the headlines that mainstream media will not touch. Now let's continue with the video. Now I need to show you what is happening in the silver market, because while gold is getting all the attention from central banks, silver is experiencing something that I think is even more alarming. The vaults are emptying across every major exchange on the planet at the same time, in a way that has never happened before. Since October 2025, we have seen a synchronized collapse of physical silver inventories across every major global exchange. Let me give you the numbers. COMEX, the largest silver futures exchange in the world. Silver inventories have plummeted from 530 million ounces to 351.3 million ounces. That is a 34% decline in 5 months. 179 million ounces gone. From one exchange in 5 months, Shanghai Gold Exchange. Silver inventories have collapsed from 39 million ounces to 14.3 million ounces. That is a 64% decline. Almost 2/3 of the silver is gone from Shanghai. Shanghai Futures Exchange, the worst of all. Silver inventories dropped from 36 million ounces to 8.2 million ounces. That is a 77% decline. The SHFE is running on fumes. 8 million ounces. That is nothing. That is a rounding error in a market that consumes over 1 billion ounces a year industrially. 3 exchanges, all draining at the same time. COMEX down 34%. SGE down 64%, SHFE down 77%. This is not a supply adjustment. This is not seasonal fluctuation. This is a synchronized global drain of physical silver from every major storage facility on Earth. And it is accelerating. Let me put these numbers in perspective. The SHFE has 8.2 million ounces left. The silver market consumes over 1 billion ounces per year between industrial use, investment demand, and jewelry. 8.2 million ounces would cover less than 3 days of global demand. Less than 3 days. That is what is left in one of the world's major silver exchanges. And COMEX at 351 million sounds like a lot until you realize it was at 530 million 5 months ago, and the rate of decline is increasing every month. At the current pace, COMEX could be below 300 million by summer. And below 300 million is territory we have not seen in over a decade. The question nobody's asking is, where is the silver going? Someone is taking it off the exchanges. Someone is converting paper positions into physical metal and removing it from the system. That is the most bullish signal the silver market can send, because it means the people who understand the market the best are choosing to hold physical metal outside the exchange system rather than leave it where it can be used to settle paper contracts. They are draining the ammunition from the paper market. And when the paper market runs out of physical to settle with, the paper price and the physical price diverge violently. I've been tracking these vault numbers every single week. And what I am seeing right now worries me. Not because I think silver is going down, because I think the system that prices silver is breaking. The exchange system was designed for a world where there was plenty of metal in the vaults. We are leaving that world fast. And nobody has a plan for what happens when the vaults hit zero. Now I want you to think about what this means in the context of what we just talked about with gold. Central banks are buying gold because they do not trust paper anymore. The physical gold market is tightening, and in silver, the physical market is not just tightening. It is collapsing. The metal is leaving the exchanges. It is going somewhere. Somebody is taking delivery and not putting it back. And the amount that is leaving is staggering. We are talking about hundreds of millions of ounces disappearing from the system in months. And here is what makes this terrifying for anyone who is short silver or anyone who thinks the silver price is going to stay at these levels. When the vaults are full, the paper market can function normally. Contracts get settled, deliveries get made, the system works. But when the vaults are 77% depleted, the margin for error disappears. One large delivery demand, one fund that decides to stand for physical, one industrial buyer that cannot source silver on the open market and decides to pull it from the exchange. Any of those things could trigger a delivery failure. And a delivery failure on a major exchange would reprice silver overnight in a way that would make the recent volatility look like a warm-up. People talk about a silver squeeze like it is some internet fantasy, but the squeeze is already happening. It is not happening in the price, it is happening in the vaults. The price will catch up. It always does. But the physical squeeze, the actual draining of metal from the system that is happening right now in real time, and the numbers I just showed you prove it. The price might say $82, but the vaults say something very different, and eventually the vaults win, because you cannot deliver silver that does not exist. Now let me tell you about something that happened in Idaho this week that nobody in mainstream media covered, and I think it might be the most important legislative development for gold and silver in decades. Idaho's state legislature introduced Senate Joint Memorial 113, SJM 113. Let me explain what this is, because this could change everything. Idaho is urging the United States Congress to create something called Treasury Trust Bonds. These would be long-term U.S. government bonds that are redeemable at the holder's choice in either U.S. dollars or a fixed weight of gold. Read that again. A U.S. government bond that you can cash in for gold. At maturity you choose, dollars or gold, your pick. When I first read this, I had to read it 3 times. The state legislature is telling the federal government to back its bonds with gold in 2026. That is not something I expected to see in my lifetime. The fact that this is being proposed by a sitting legislature, backed by a former Fed board nominee, tells you how far the conversation has moved. 5 years ago, this would have been dismissed as fringe. Today, it is a formal legislative memorial with bipartisan support. This proposal is backed by Judy Shelton, a respected economist and former Federal Reserve Board nominee. The memorial cites the U.S. Constitution's power to coin money and regulate its value. It cites the fact that U.S. federal debt now exceeds $38 trillion. It cites the fact that without the backing of a tangible asset like gold, there is no limit to how much debt can be created. And it proposes that the U.S. government use a portion of its 261.5 million troy ounces of gold reserves to collateralize an initial issuance of these bonds. The proposed launch date is July 4th, 2026, America's 250th birthday. The symbolism is deliberate. Idaho joins Utah and Wyoming in the growing sound money movement. These states have already enacted laws recognizing gold and silver as lawful money, but SJM 113 goes further. It is not just saying gold is money. It is saying the federal government should issue bonds backed by gold. That is a direct challenge to the current system where treasury bonds are backed by nothing but the full faith and credit of a government that is adding $1 trillion of debt every 100 days. Now let me be clear. This is a non-binding memorial. It is not a law yet. It is Idaho telling Congress to act. But the fact that a state legislature is formally urging the federal government to tie treasury bonds to gold tells you where the political wind is blowing. And when you combine this with the Bloomberg data showing central banks have already shifted their reserves from treasuries to gold, you start to see a pattern. The world is moving toward gold-backed systems. Some countries are doing it quietly through central bank purchases. Some states are doing it loudly through legislation. But the direction is the same, away from pure fiat, toward hard assets. And think about the timing. Idaho introduced this bill on February 25th, the same week central bank reserves crossed over. The same month, silver vaults accelerated their drain. The same month, a war broke out that is threatening global oil supply. The same month, the dollar surged and gold crashed, and the entire financial system started shaking. You can call it coincidence, I call it convergence. Everything is pointing in the same direction at the same time. The institutions are buying gold. The governments are legislating gold. The vaults are draining silver. The miners are being killed. And the markets are still trying to figure out what it all means, just like 1973. The market is always the last to know. I want to say something real for a moment. I have been covering gold and silver for a while now, and I have never felt the way I feel right now about where we are. Not excited, not scared, just aware. Aware that the data I showed you today is not normal. A 30-year crossover in central bank reserves is not normal. Silver vaults draining 77% in 5 months is not normal. A state legislature pushing for gold-backed treasury bonds is not normal. Miners being executed by cartels at the world's largest undeveloped silver deposit is not normal. And a 1973-style energy crisis playing out week for week in real time is not normal. None of this is normal. And the people who treat it as normal and go back to watching the Daily Candle are going to miss what is happening underneath. The Daily Candle is noise. What I showed you today is signal. And the signal is the loudest it has been in 30 years. Now I need to talk about something that is affecting silver supply in a very real and very human way. And I want to handle this with the seriousness it deserves because real people lost their lives. In January, 10 workers at Vizsla Silver's Panuco project in Sinaloa, Mexico, were kidnapped by members of the Sinaloa cartel. The mine is in an area that has been torn apart by a civil war between cartel factions. The workers were abducted from their residential compound near the city of Concordia. The cartel reportedly demanded 10 million pesos per worker. The ransom was not paid. All 10 workers were killed. Families had to go to the Federal Attorney General's office in Mazatlan to identify the bodies of their fathers, brothers, and sons. Engineers, geologists, working people who went to work one morning and never came home. I want to pause here for a second. We spend so much time talking about charts and prices and deliveries that sometimes we forget there are real people on the other end of this market. 10 men died because they went to work at a silver mine. One of them was a 26-year-old engineer named Pablo Osorio, whose family could not afford a ransom. His uncle told reporters he was just trying to make a living. That is the human cost of the silver supply chain. And it deserves to be mentioned with the same seriousness we give to the price charts. Mexico produces 24% of the world's silver. 1/4 of global silver supply comes from a country where cartel violence is so severe that miners are being kidnapped and executed at their work sites. The Panuco project has been shut down since the kidnappings. Vizsla's stock has dropped over 40%. And the broader message to every mining company operating in Mexico is clear. The security risk is real and it can be fatal. The Panuco project was projected to produce over 17 million silver equivalent ounces per year. That production is now zero, and Panuco is not the only project at risk. The entire state of Sinaloa has been engulfed in a cartel civil war for the past 18 months. Over 2,700 intentional homicides. Over 3,000 people reported missing. Any silver mine operating in that region is now a target, and Mexico is not just any silver producer, it is the largest silver producing country on earth. When the world's biggest silver producer has a security crisis that is shutting down mines and killing workers, at a time when global silver inventories are already draining at historic rates, the supply picture goes from tight to critical. This is not an abstract supply risk on a spreadsheet. This is miners being killed, and every mine that shuts down, every company that pulls back, every worker who refuses to go back to a site where their colleagues were murdered. That is silver supply that is not coming to market. Now let me bring everything together with the historical parallel that I told you about at the beginning, because this is the part that ties it all together, and I think it is the most important context I can give you right now. 1973, the oil embargo. OPEC cut off oil supplies to the United States. Oil prices quadrupled. The economy went into shock. And here's what happened in the financial markets. For the first 6 weeks after the oil shock, gold and gold miners went sideways and even down. 6 weeks. The market did not react the way you would expect. Stocks started falling, but gold did not rally immediately. People were confused. The world is falling apart, oil is quadrupling, and gold is not moving. Sound familiar? Then the rally started. Gold miners exploded 193% higher. The broad stock market crashed 48%. In the same window, 193% up for miners, while the stock market dropped 48%. That is a 241 percentage point spread between gold miners and the stock market. All because the market took 6 weeks to figure out what was happening. Let me say that differently so it really lands. If you had put money into gold miners instead of the stock market. After the 1973 oil shock, you would have made 193%, while everyone else lost 48%. The difference between understanding the setup and not understanding it was the difference between generational wealth and generational loss in the same economy, in the same time period. The only difference was what you owned. Now look at where we are in 2026. Oil prices spiking because of the Iran war and the Strait of Hormuz. Same dynamic as 1973. Energy shock, inflation spike, economic uncertainty. And gold and silver have been going sideways and even crashing for the last 5 weeks. 5 weeks. Almost the same time frame as the 1973 delay. The market has not figured it out yet, just like 1973. And here is what gives me chills about this parallel. In 1973, the world was not dealing with silver vault drains across 3 exchanges. It was not dealing with central banks shifting from treasuries to gold. It was not dealing with state legislatures pushing for gold-backed bonds. It was not dealing with 40% of the world's population actively de-dollarizing. All of those things are happening now on top of the energy shock. The setup in 2026 is not just similar to 1973. It might be bigger, because the structural forces pushing toward gold are deeper and wider than they were 50 years ago. If the parallel holds, and I'm not saying it will, but if it holds, we are sitting right at the inflection point. The 6-week digestion period is almost over. The point where the market wakes up and realizes that an energy crisis plus inflation plus a war plus central banks buying gold at record pace plus silver vaults draining plus the dollar's reserve status being challenged for the first time in 30 years equals gold and silver going significantly higher. Not gradually, explosively. The way it happened in 73, I'm not making a prediction. I'm showing you a historical parallel. The conditions are remarkably similar. The timeline is remarkably similar, and the market's initial reaction of confusion and sideways movement is remarkably similar. What happened next in 73 is a matter of public record. What happens next in 2026 is the question that every person watching this video needs to ask themselves. Gold has overtaken US Treasuries in global reserves. Silver vaults are draining at 77% across exchanges. Idaho is pushing for gold-backed treasury bonds. Miners are being killed in Mexico, reducing silver supply. The 1973 parallel is lining up week for week, and central banks representing 40% of the world's population are openly moving away from the dollar and into gold. Every one of those data points on its own is significant. Together, they tell you a story. The story is that the financial system that has run on paper for the last 30 years is starting to shift back toward hard assets. Not because of sentiment, not because of conspiracy, because of math. The math on US debt does not work, the math on silver supply does not work, and the math on central bank reserves just crossed a line that has not been crossed in 3 decades. Drop a comment. Tell me what you think this means. Do you think the Treasury's crossover is the beginning of the end for dollar dominance? Do you think the silver drain leads to a delivery failure? Is the 1973 parallel going to play out? I want to hear your analysis. I will pin the best ones. Share this video. The Bloomberg chart alone is something most people have never seen. The silver vault data is public, but almost nobody is compiling it across all 3 exchanges the way I showed you today. And the Idaho gold bond bill got 0 mainstream coverage. Help me reach the people who need to see this data before the market figures out what it means. If you are new here, go watch the previous videos in order. The dollar crash video, the COMEX delivery data video, the war escalation series. They all connect to what I showed you today. Links in the description. This is the hidden economy. Gold at 30.4% of global reserves. Treasuries at 29.7%. The crossover just happened. Silver vaults collapsing across 3 exchanges. Idaho pushing gold-backed bonds. Miners being killed in Mexico. And the 1973 playbook says the next move starts right about now. Follow the data, not the noise.